We just talked about the Hang Seng closing correction territory, some of the issues in China's property sector weighing on the European markets in the early trade. How do you see it impacting the U.S. markets today?
Yeah, I do think the U.S. markets will continue their near-term weakness. We've been saying for a while that three things in the market. First of all, the U.S. consumer is struggling. You've seen savings rates coming down. The San Francisco Fed yesterday talked about this. You're also seeing credit card usage increasing, stressing the consumer. Second of all, the Fed. We have the hangover from the Fed's meeting minutes. We can talk about this later. But the Fed's meeting minutes, higher for longer, is here for a while. And the third point, valuations. Valuations in the U.S. stock market, 19 times forward earnings for the S&P 500. We have rising rates. Valuations at this level don't make sense with rising rates. So this is something we're watching very carefully. All these together creates this intense market volatility, which will continue.
So you're saying it's hitting, the rising rates are hitting the valuation plays right now. So specifically, are you talking about big tech, or are there other areas of the market hit by these rising rates where the valuations are now having investors at least scratch their head or maybe take a closer look?
Yeah, I think clearly big tech is taking the big hit. I mean, big tech, obviously, given the fact low interest rates are used to price out tech equities on a go-forward basis, but you're seeing this spread out through the rest of the market. Yes, we're seeing market.
What sectors in particular? Is there one sector we should be watching today because of this?
I would look at consumer discretionary. Again, the consumer overhang. I would also look at industrials to an extent, especially with the market volatility, especially the uncertainty about a rising dollar, given the news we saw over last night from the yuan. And then I think overall, just really telecommunication services, there's some big issues there.
All right, so a couple sectors there. Let's get technical. You're looking at some technical things right now. You're focused on the S&P falling below its 50-day moving average, something we just hit just a moment ago. And then on a technical basis, you say the 200-day moving average of 41.38. That's the next level of support.
Exactly.
What does that mean in the near term? Because obviously we're seeing, Wall Street have a very tough week.
Yes. Yeah, I think so. So that's, so we've been saying to our advisors for a long time, near-term market weakness, market pullback, maybe a potential correction. That could bring us down to the 200-day moving average. That's a good support level, 41.38. Will it drop there right away? It's going to take a little while, just as we get good news and bad news. I think also the NASDAQ composite, the NASDAQ, the next level is watch carefully for 200-day moving average.
All right. You mentioned the Fed. You mentioned rising rates for 33 days from the next Fed meeting. Despite those Fed minutes where they made it pretty clear, higher for longer, look at the CME tool this morning, still a 90% chance of no hike at all. Is Wall Street fooling itself? Are they fighting the Fed? Or do you believe that the Fed may actually pause?
I do think the Fed will pause. I think the meeting minutes, 3 C's came out from the meeting minutes. First of all, we saw caution from the Fed. The Fed alluded to the fact that they may raise rates to address inflation. Second of all, the Fed is very confused. They said inflation is high, but they also said at the same time that rates are very restrictive. And the third thing is that they're confirmation, that's the third C, is that they're confirming that they're focusing on data. Take all this together, this is what scared the market because retail sales, GDP came in above expectations. Our perspective going forward is this, is that the Fed is pausing. The Fed is done for the rest of this year. They're pausing, but higher for longer. Higher for longer because inflation is still high, not at their target, but services inflation is still extremely elevated. And you take all this together and you have this uncertainty that the Fed needs to stay higher for longer.